Let's be honest, dividends are great, and when you get some in your account, it's a pretty nice feeling. I've been paid many thousands of dollars throughout my investing journey. You've not had to do the work, and you've been given a share of a company profits. However, before you go rushing off to put all of your investments into dividend stocks, you need to consider a few of the downsides that rarely get spoken about on YouTube. There's lots of people showing you the companies you should buy, but not many telling you all of the downsides and all of the risks. So I've put together some of my biggest problems with dividends all in one place. Up first, you need to remember that a dividend isn't just magic free money. Well, it kind of is in a way, but it does have to come from somewhere. Remember that a dividend is typically going to come out of companies' profits. So if, for example, a company makes $1 million of profit, they might choose to pay out $500K as dividends. Now that $500,000 of cash, once it gets paid, is then lost from the value of the company. As you can guess, if you've owned the company, you've gone from having $1 million in cash to $500,000. So your company is now worth less to potential investors. You'll actually see this happening live if you ever watch the price of a stock. Let's say Coca Cola is worth $50 a share and they're paying out $1 worth of dividends for every share you own. Now, on the day that the company goes what's known as ex-dividend, the price of the share will actually drop by $1 to become $49. This ex-dividend date can be easily found in advance, and it's the point that all of the shareholders of the company need to be registered to actually get their dividend payment. If you're not a shareholder on that date, then you won't get your payment. So just be aware, it's not free money, but the stock market is free to do whatever it wants. The company could still go up in value from $49 to $50 that day, but it won't get that dividend payment back. That's no longer their money, it's for shareholders. Next up, this point probably doesn't get brought up enough here on YouTube, and it's one of every investor's pet hates: taxes. Now, this one all depends on where you live, what accounts you invest with, and any tax breaks you might get. But it could be the difference between taking home thousands of dollars each month or just having hundreds. For example, let's use the US and the UK as examples here. If you invest in the US inside of your Roth IRA, then all of your dividends received are tax-free. However, if you invest in a regular brokerage account, then you will owe taxes depending on your filing status and income bracket. So if you make household income of $100,000 between two people per year, then your bracket will be around 15%, meaning that if you make $1,000 in dividends, you'll owe $150 in taxes. Similar here in the UK, if you use a stocks and shares ISA, you can get back all of your dividends tax-free, but if you receive dividends outside of that account in a regular account, then you do get £2,000 a year tax-free, but after that you need to check your income tax brackets. It ranges from 8.75% up to 39% for you guys who are better off. Next up, sorry to burst your bubble, but if you want to make a lot of money with dividends, then the only way to do that is going to have lots of money invested in the first place. I know lots of people like to talk about $100 a week or $1,000 a month in dividends, but you can only do that if you have enough money invested in the first place. There are no shortcuts here, I'm afraid, but don't get too worried. You can definitely get there and it's very achievable, but you do just need to be realistic. For example, if you wanted to make $1,000 a month in dividends, around $800 a month for us UK folk, you're going to need around $240,000 at least, and that's assuming that you're invested in companies paying you around 5% per year as a dividend yield, which, if we're being honest, might also be a bit too generous. Going back to some popular dividend stocks like Johnson & Johnson or even Coca Cola, you'll see that they play closer to 3 to 4%, meaning that you'll probably need more like $400,000 in your investing portfolio to see $1,000 per month. That's a lot of money, but you can definitely get there, I promise, but it will take a lot of time. Many years of investing will get you there with a lot of patience along the way. For example, if we say you can save $500 a month over 23 years, allowing for 8% a year return on average, we actually get to $397,494.66. So if you start now, you'll be done by 2045. So maybe meet me back here in a party when you're done in the comment section. But seriously, don't get disheartened, just be realistic. Nothing worth having comes quickly. Another thing which gets left out as well, especially on YouTube, is forgetting to mention trading charges and commissions. Now let's say you want to reinvest your dividends, so every time that you do get paid, you just want to buy more of the same company. Now, it's a really great way to build up a lot of money over the long term. The problem is nothing is free, at least not completely. If you use newer platforms that are commission free, maybe something like Robinhood or Webull in the US, or companies like Free Trade and Trading 212 here in the UK, then technically you can invest your money for free and just reinvest easily. But some older platforms and traditional ones will charge you every time you make a trade. So for example, here in the UK, and I'm sure there are similar ones in the US, Hargreaves Lansdown, a broker that I actually use for one of my main accounts, charges £11.95 per trade, and for a reinvestment they charge a 1% fee at a minimum cost of £1. Now this means that if I'm only working with a small account and trying to make it grow, I could end up losing 10% of my dividend in charges if, say, I only wanted to invest £10, which is going to have a major effect on how long it takes to grow my account. Every broker is going to be different here, so please just check out the small print and make yourself aware. Otherwise, you have to save a few more months or even years if you want to finally make that $1,000 a month. Just before we jump into our next point, if you are enjoying the video so far, please drop me a big fat like and consider subscribing too. It's completely free and I can make more content like this for you. Now, back to the dividends. This one's always getting in the way. Dividends can also be dangerous sometimes, but let me explain. Some companies pay out way too much money to shareholders in their dividends, and some of them even pay out to attract new investors, almost like trying to catch you on a fishing hook as if you were swimming around looking for cash. The problem is, if a company pays out money that it doesn't have or has to go into debt to do it, then inevitably they could end up going out of business and have no cash left to run their own business and grow. It's known as the dividend trap, and it's when us investors get very excited when we see big amounts of cash and large dividend yields on a company that we think that can suddenly get 10%, 20% or even more paid back to us each year consistently. Unfortunately, I wish that were true, but even Bernie Madoff, who ran one of the most lucrative Ponzi schemes of all time, only promised investors 10% back, so look what happened to that guy. I'll show you a couple of examples. This one caught me out, but it's still a good reminder nonetheless. A couple of years ago, I invested into Evraz, which is a London-listed company, but one that operates in Russia and Ukraine in the mining sector. You can already see where this one's going. They produce coal and steel and make a lot of money doing it, and they're a big dividend payer too. Now, at one point I was getting over 10% back through dividends, while also seeing the share price grow as everything was going up and steel was rising. I thought everything was great. But then of course the Russia invasion of Ukraine happened and the FTSE actually got delisted from the FTSE 100 and has lost nearly 90% of its value. Currently, you can't even trade the company, so it sat in my account as a big fat reminder that anything can happen in the world, so don't go putting all of your eggs in one basket. And even though the company's still working away producing lots of cash, we've got no idea what will happen with it, so I'll have to probably keep you updated on my regular portfolio updates on that one. A second example, not so extreme, is a company I recently looked at in the shipping sector. It's called Zim. Now, I know very little about this, but if we just look from a high level, we can see a huge dividend yield of nearly 30%. A return like that would get you $300 back for every $1,000 you invested each year, and within 10 years at $500 a month, you'd already be at $400k. However, the problem is that this amount of payment is clearly going to be unsustainable. There's not enough history here to see how a dividend has been paid. There's very little track record, and we know that historically, some of the best dividend paying stocks in the world couldn't sustain this kind of level. So the lesson here is just to be very careful and skeptical. Make sure you've checked on the track record of the company and made sure that any dividend they do pay or have paid has been reliable, as in sustainable for them. Otherwise, you'll end up potentially losing everything while the company tries to look good but ends up slowly dying. Avoid the dividend trap and stick to a more kind of sustainable amount of return. Something like 3 to 5% yield per year might be a lot more realistic. That's not to say that you can't find exceptions, but if it's too good to be true, then it usually is. Turns out that phrase is also effective in investing too. And for my last point, remember that if a company's paying a dividend, it's because there's nothing else that can do better with the money. Now, this might sound like a strange view on things, because if you were a shareholder and a company made lots of cash, then you'd probably want to have it in your own pocket as you're entitled to it. But personally, wouldn't you rather use that money to help grow the business even faster, or reduce their levels of debt, or even go out and acquire other companies? Just remember there's always going to be a trade-off here. Typically the big dividend paying companies are already pretty big, slow growing, and don't have many more ways to spend their cash. So they actually just pay it out to shareholders like you and me instead. And while this can be a good thing, what if we don't need the money for another 20 years? There might be better opportunities in the stock market, including just buying index funds that might actually get us better return in the long run. I mean, there's nothing stopping you from making your own dividend payments. Just invest in the S&P 500 as a whole index and sell 5% each year or parts of it every month, and you've got yourself your very own dividend. You could make this in 100 different ways, and there are also ETFs and mutual funds already out there that do exactly this, so you don't have to spend time trying to find which stocks to buy. Find what works for you and have fun. Now, with all of that said, I do have a soft spot for dividend companies, and I think it's a great way to build your wealth, keep yourself motivated, and actually get rewarded for being a shareholder of a company. But, as we've just seen, you do need to make sure that you understand some of the downsides too. Personally, for me as someone who wants to build wealth over the next 20 or 30 years, I don't need any of that stream of income from the stock market, but over time I might like to use more dividend-based stocks to become my source of income, and I do actually have a small dividend portfolio on free trade, which you can actually go ahead and watch, which is in the link in the description below. In the long run, there are a ton of dividend stocks that have done really well, and some of the best companies in the world also pay dividends. In fact, most of the S&P 500 and most of the FTSE 100 in the UK pay a dividend of some kind. I mean, even Apple, one of the biggest companies in the world, pays a small dividend to its shareholders. It might be less than 1%, but it makes Warren Buffett a lot of money every year. I'd take 1% of that payment if you're watching, Warren. I'll send you my bank details later. Although there are plenty of traps out there, generally lots of stable and highly profitable companies pay out a dividend, and it can be a great way to return value to shareholders. Ultimately, in the long run, once the company stops growing 20, 30 or 40% per year, it will run out of steam and have to do something with all of that extra cash. So it's almost inevitable that some of the big tech companies that you see today could end up turning into big dividend giants of tomorrow. Just watch this space. Anyway, if you are interested in starting your own dividend portfolio, watch this next video here if you're from the UK, as this one will really help you get started. Otherwise, if you live anywhere else and you just want to see what a dividend portfolio might look like, here's my latest update from Free Trade Portfolio that I mentioned earlier. I'm currently growing it and it's got some of the best UK-based companies here that trade all over the world. Finally, don't forget to leave me a like if you enjoyed the video, subscribe for many more videos, and as always, happy investing.